Honestly, a mix of respect and irritation. Respect for how clearly it dismantles a lot of financial mythology, and irritation because its core message is deeply uncomfortable for people who want to feel smart, special, or in control.
That discomfort feels intentional. The book almost dares you to argue with it. It says, very calmly, most of what you believe about beating the market is probably wrong.
Yes, and not wrong in a dramatic way, but wrong statistically, quietly, relentlessly, which is much harder to accept.
Let's start with the central metaphor, the random walk. Markets move in ways that are largely unpredictable, and past information is mostly baked in. Did you find that argument convincing?
Conceptually, yes. Emotionally, it's hard. Humans are pattern seeking machines. Being told that patterns are mostly illusions feels like an attack on our intelligence.
Because if prices move randomly, then insight loses its glamour.
Exactly. Skill becomes suspect. Expertise becomes probabilistic rather than heroic.
Malkiel spends a lot of time dismantling technical analysis, chart reading, trend spotting. Did any part of you want to defend those practices?
I wanted to defend the intuition behind them. The idea that markets reflect human behavior and human behavior has patterns. But Malkiel's point is brutal. Even if patterns exist, they're quickly exploited and erased,
So any edge is temporary.
and usually gone by the time it's widely recognized, which makes chasing it expensive and futile.
That leads directly into his critique of professional money managers. This is where the book becomes almost confrontational. The claim that most professionals underperform the market over time, did that surprise you?
It didn't surprise me intellectually, but it still felt jarring. We're conditioned to believe that expertise guarantees superiority. The data suggests otherwise.
And the reasons he gives are almost mundane: fees, taxes, turnover, overconfidence.
Yes, not dramatic failures, just small, consistent leaks. Death by 1,000 cuts.
Which is ironic, because active management is often marketed as protection.
Right, protection from uncertainty, volatility, ignorance. But the cost of that protection quietly compounds against you.
There's something almost philosophical here. The book seems to argue that humility outperforms confidence.
That's a great way to put it. Index investing is institutionalized humility. It says, I don't know which stocks will win, so I'll own them all.
That idea runs directly against ego.
And against storytelling. Humans love stories about winners, visionaries, geniuses. Index funds are boring by design.
Malkiel doesn't just argue that markets are hard to beat. He argues they're hard to even understand in hindsight. Did that undermine your faith in financial narratives?
Very much so. We love retroactive explanations. We say markets fell because of this rose, because of that. The book suggests those explanations are often fiction layered on randomness.
Which makes financial news feel almost theatrical.
Yes, it provides emotional closure, not predictive power.
Here's an imaginary scenario. Suppose you're offered a system that claims to beat the market consistently, but you're not allowed to see how it works. You're just shown impressive past returns. What does Malkiel tell you to do?
Run. Past performance without transparent logic is meaningless. Survivorship bias alone could explain it.
That idea of survivorship bias is one of the book's most important contributions for general readers.
Absolutely. We only hear about the funds that survived, not the ones that quietly died. That skews perception massively,
It also feeds the illusion that success is more common than it is.
and that failure is personal rather than statistical.
Malkiel also critiques fundamental analysis, not as harshly but still skeptically. He acknowledges its logic, but doubts its effectiveness at scale. Where do you stand on that?
I think fundamental analysis makes sense conceptually. Valuation matters. But again, the issue is competition. If everyone has access to the same information, the advantage disappears.
So information isn't power.
Not once it's public. Power comes from cost control, patience, and discipline.
which are deeply unsexy virtues.
Exactly. They don't sell newsletters.
The book also dives into historical bubbles, tulipssouthsea.com. What role do these stories play in his argument?
They show that intelligence doesn't inoculate against speculation. In fact, smart people often rationalize bubbles more convincingly.
That was one of the most unsettling takeaways for me. That knowledge can amplify delusion rather than prevent it.
Yes, rationalization is more dangerous than ignorance.
Do you think Malkiel underestimates human psychology, or does he understand it too well?
I think he understands it very well, but he chooses not to indulge it. The book isn't trying to comfort our instincts. It's trying to discipline them.
That discipline theme feels similar to what we discussed in the Springsteen conversation. Interestingly,
It does. Discipline is survival, but in a different domain.
before we go deeper, I want to ask you this. If the book is right, why do so many people still believe they can beat the market?
Because believing you're average is psychologically painful. The market isn't just a financial arena, it's an ego arena.
And accepting market efficiency feels like surrender.
Yes. Even though it's actually a strategic surrender,
That tension between surrender and strategy might be the heart of the book.
I think so. It asks you to redefine what intelligence looks like.
All right, let's hold that thought, because next I want to dig into index funds, asset allocation, and the emotional cost of long-term investing. Let's dig into index funds, because that's where the book stops being merely descriptive and starts being prescriptive. Malkiel doesn't just say markets are hard to beat. He says most people should stop trying. That's a strong claim. Did you feel any resistance to it?
A lot. Not because it's poorly argued, but because it strips investing of drama. Index investing feels almost anti-narrative. You don't get to feel clever. You don't get to attribute success to your insight. You just participate.
Participation instead of domination.
Exactly. It reframes investing as something closer to gardening than gambling or warfare. You plant, you wait, you accept whether you can't control.
Malkiel argues that asset allocation matters far more than stock selection, that what you own broadly is more important than which specific names you pick. Did that surprise you?
It surprised me the first time I encountered the idea years ago. Now it feels obvious, but that's only because the book and others like it have reshaped the conversation. At the time, it was almost heretical.
It also places responsibility back on the investor rather than the market. You choose your risk exposure, your time horizon, your diversification.
Yes, and that's an important distinction. The book doesn't say you're powerless. It says your power is structural, not predictive.
That's a great phrase. Structural power instead of predictive power. You can't foresee the future, but you can decide how fragile or resilient you are to it.
Exactly. Diversification is basically humility operationalized.
Malkiel also emphasizes time in the market over timing the market. This feels almost cliché now, but he builds a strong case for it. Why do people still struggle with this idea?
Because waiting is psychologically hard. Doing nothing feels irresponsible, especially when markets are volatile. Action feels like control, even when it's counterproductive.
So inactivity feels like negligence, even when it's rational.
Yes, the emotional cost of patience is underestimated. Watching your portfolio drop without intervening requires systems rather than instincts.
That faith is repeatedly tested during crashes. Malkiel talks about market downturns as inevitable but temporary. Did you find that reassuring or dismissive?
Reassuring in theory, terrifying in practice. When you're inside a crash, statistics don't soothe you. Loss feels personal, even if it's systemic.
Another imaginary scenario, you've built a diversified, low-cost portfolio exactly as Malkiel suggests. Then the market drops 40%, no immediate recovery in sight. What does the book tell you to do?
It tells you to do almost nothing. Rebalance if necessary. Stay invested. Trust the long-term trend, which feels almost cruel when emotions are screaming at you to escape.
So the real challenge of investing isn't knowledge.
It's temperament.
That's one of the most understated but powerful messages in the book. Intelligence doesn't guarantee good outcomes. Emotional discipline does.
Yes, and emotional discipline isn't glamorous. It doesn't make for good stories,
Which might explain why so many people ignore it.
and why financial media thrives on urgency. Calm doesn't generate clicks.
Malkiel also spends time discussing risk, especially the idea that risk isn't just volatility, but the chance of permanent loss. How did that reshape your thinking?
It reframes fear. Volatility feels scary, but it's not inherently dangerous if you have time. Permanent loss, concentration risk, and behavioral mistakes are the real threats.
So risk isn't what moves the most.
It's what can't recover.
That distinction feels crucial, especially for younger investors who panic at short-term swings.
Yes, without time perspective, volatility masquerades as catastrophe.
The book also addresses bonds, international exposure, and rebalancing. Some critics say these sections feel dated. Did that bother you?
Not really. The specifics evolve, but the principles remain. Diversification across asset classes, awareness of inflation, matching risk to life stage. Those ideas age well.
Speaking of life stage, Malkiel strongly emphasizes tailoring your portfolio to your circumstances. Age, income stability, goals. How important is that customization?
It's essential. The book isn't dogmatic in the way critics sometimes suggest. It doesn't say one portfolio fits all. It says one philosophy should guide all.
Which is often misunderstood.
Yes, people hear index investing and think passivity, but it's actually very intentional. You're making your decisions, but they're more consequential.
There's also a moral dimension to the book that's rarely discussed. By discouraging speculative behavior, it implicitly discourages zero-sum thinking. Did you pick up on that?
I did. Speculation often relies on someone else being wrong. Long-term investing relies on collective growth. It's a more cooperative vision of capitalism.
That's fascinating because markets are usually framed as competitive arenas.
They're in the short term. Over the long term, they reflect productivity, innovation, and shared progress.
Malkiel isn't naive about inequality or market failures, but he seems optimistic about long-term growth. Did that optimism feel justified?
Cautiously justified. History supports it, but only with diversification and patience. The optimism is conditional, not blind.
Another imaginary scenario. Suppose a young investor reads this book and decides to ignore all market news for 30 years, investing automatically in index funds. Is that wisdom or negligence?
It's wisdom if paired with periodic review and rebalancing. Negligence only if it becomes complete disengagement. Awareness still matters, just not obsession.
So the goal isn't ignorance.
It's selectivity.
That's a subtle but important difference.
Yes, you reduce noise, not knowledge.
Let's address one of the most common criticisms of the book, that markets aren't always efficient, and there are anomalies, behavioral biases, and moments where active strategies can work. Does that undermine Malkiel's thesis?
Not really. He acknowledges anomalies. His argument is probabilistic, not absolute. Even if inefficiencies exist, exploiting them consistently and cheaply is extraordinarily difficult.
So the existence of exceptions doesn't invalidate the rule.
Exactly. Especially when transaction costs and competition erode advantages.
That probabilistic framing feels key. The book isn't saying you can't beat the market. It's saying you probably won't, and trying is costly.
Yes. And most people confuse possibility with likelihood.
Which is dangerous in finance.
Very.
Before we move to the final stretch, I want to ask you something personal. Has this book changed how you think about your own financial decisions?
It's reinforced my skepticism toward complexity. When something is overly intricate, I now ask who benefits from that complexity. Usually, It's not the investor.
So simplicity becomes a form of defense.
Yes, against both markets and marketing.
That feels like a good place to pause. Next, I want to talk about what the book gets wrong, or at least understates, and what kind of mindset it ultimately asks us to adopt. Let's talk about what the book might get wrong, or at least where it leaves things unresolved. Because no framework, especially one this influential, should be immune to scrutiny. Did anything strike you as overly confident or incomplete?
I think the biggest limitation is that the book focuses heavily on averages, on what works for most people most of the time. That's intellectually honest, but emotionally unsatisfying. People don't experience life as an average. They experience it as individuals.
So the advice can feel impersonal.
Yes, if someone is in a precarious financial situation, being told to wait decades for compounding to work can feel disconnected from reality.
That raises a broader question about access. Index investing assumes a certain level of stability, income, and time horizon.
Exactly. The book is most useful for people who already have some margin. It's not a universal solution to financial insecurity.
Do you think Malkiel underplays systemic risk? Things like prolonged stagnation, political upheaval, climate shocks.
I think he acknowledges them but treats them as unknowable variables. His response is diversification rather than prediction. But that can feel insufficient when risks feel existential rather than cyclical.
So diversification protects you statistically, but not emotionally.
Yes. And the emotional dimension is where many investors fail.
Another criticism often raised is that widespread index investing could distort markets. If everyone stops analyzing individual stocks, price discovery suffers. Do you find that concern valid?
In theory, yes. In practice, no. As long as some active participants exist, price discovery continues. And ironically, the presence of index investors creates opportunities for active traders, even if most won't exploit them successfully.
So the ecosystem self-corrects.
To a degree, markets are adaptive systems.
That adaptability seems central to Malkiel's confidence in long-term growth.
Yes. He's betting on human ingenuity more than market perfection.
Let's talk about behavior again, because the book repeatedly returns to it, even if implicitly. If markets are efficient, why do bubbles keep forming?
Because efficiency doesn't eliminate emotion, it aggregates it. Bubbles are collective behavior amplified by feedback loops.
So efficiency doesn't mean rationality.
Exactly. It means information is quickly reflected, not wisely interpreted.
That distinction feels important, especially in the age of social media-driven speculation.
Yes, information travels faster, but wisdom doesn't.
Another imaginary scenario. A new technology emerges, promising to revolutionize everything. Prices skyrocket. Everyone around you is getting rich quickly. What does Malkiel tell you to do?
Be skeptical of narratives. Separate technological promise from valuation reality. Diversify your exposure rather than concentrate it.
Which often feels like missing out.
Yes, and fear of missing out is one of the most expensive emotions in finance.
The book doesn't talk much about happiness, but it implies something about it. That financial piece comes from predictability rather than excitement. Do you agree?
I do. Excitement is costly. Peace compounds quietly. The book implicitly values financial serenity over financial thrill.
That's almost countercultural.
Very. We're taught to chase excitement in every domain.
So what mindset does the book ultimately ask us to adopt?
One of probabilistic humility, accepting that you don't know the future and building systems that don't require you to.
That feels almost philosophical.
It is. It's stoic in a way. Control what you can, accept what you can't, and don't confuse effort with effectiveness.
If someone misreads the book, what's the biggest mistake they might make?
Confusing passivity with discipline, ignoring markets entirely without a plan, or assuming that index investing absolves them of responsibility.
because responsibility doesn't disappear.
It shifts from prediction to preparation.
I like that. Preparation over prediction.
That might be the book's most durable lesson.
As we wrap up, I want to ask you something similar to what I asked in our last conversation. After reading this book, do you feel more or less confident?
Less confident in my ability to outsmart markets. More confident in my ability to build a resilient approach.
That's a meaningful distinction.
Yes, it replaces ego with process.
Do you think that's why this book has endured for so long?
I do. Markets change, instruments change, but human psychology doesn't. The book speaks to that constancy.
So it's less a book about finance and more a book about human behavior under uncertainty.
Exactly. Finance is just a laboratory.
If you had to distill the message into a single sentence, what would it be?
You don't win by being clever. You win by being consistent.
For me, it would be this. The smartest move is often admitting what you don't know,
That's a hard lesson.
but a liberating one.
Yes. Once you stop trying to beat the market, you can start using it.
Chris, thank you for taking this journey with me. This has been one of those conversations that quietly reshapes how you think.
Thank you, David. Those are the best kind.
And to everyone listening, thanks for staying with us. Until next time.